The next piece on First Word today. Lower crude prices may have put a smile on consumers' faces in the last 2 months of 2018, but the same can't be said about oil marketing companies which process the crude. That's because the inventory is usually bought earlier. Soumeet Sarkar's put this in, or here, to put this into perspective. Soumeet, thanks so much for joining in. What can we expect from OMCs?
Well, you can expect a loss. There's a high probability that all the three oil marketing companies may come out with a loss in the third quarter of financial year 2019. Now, this is because of two reasons. The sharp fall in crude prices and second is weak gross refining margins. Now, in Q3, crude averaged 9% lower compared to last quarter at around $68.81 per barrel as compared to $75.89 per barrel reported by in the second quarter of financial year 2019. Now, whenever crude prices have averaged lower compared to last quarter, all the three oil marketing companies have reported an inventory loss, and that is because oil refiners maintain an inventory, and whenever the price falls, refiners that bought the stock at higher prices end up selling it through retail outlets at lower prices. Now, because of this sharp fall in crude prices in the third quarter, there's a high chance that they might report an inventory loss. Now, if you see in the first quarter of financial year 2018, when crude prices had averaged lower compared to the last quarter, all the three oil marketing companies had reported an inventory loss of close to 6,200 crore rupees. Post that, they have been reporting inventory profits for the next 5 consecutive quarters, and in Q3 they're expected to report a loss for the first time in the last 6 quarters. Now, secondly, concerns around this oversupply amid a tepid demand growth have also weighed on the gross refining margins. In fact, in the month of December, if you see, it went as low as $2.38 per barrel. That is the Singapore gross refining margins. However, for the quarter ended December, Singapore gross refining margin, that is the Asian benchmark, averaged at $4.3 per barrel. That is the lowest at least since the third quarter of financial year 2014. Now, a lower gross refining margin means that the oil refiners will earn less for every barrel of processed crude. However, all was not bad for the state-owned oil marketing companies. Now, this fall in crude prices at least helped them to recoup their losses in the marketing business. Now, despite the fact that government had asked them to bear the 1 rupee impact on the gross marketing margin, if you see the actual gross marketing margin that they earned in the third quarter on an average was higher compared to the second quarter. In third quarter, on sale of every liter of petrol and diesel, the average gross marketing margin earned by these oil marketing companies were around 3.6 rupees and 3.2 rupees per liter, which was higher compared to the second quarter of financial year 2019. Now, this sharp rise in the gross marketing margin will definitely boost the marketing segment of all the three oil marketing companies, especially HPCL, because that earns the most through sale of retail fuels in its EBITDA, and that's the reason the HPCL will see a big boost coming in from the marketing business. However, an inventory loss and a lower refining profit will weigh on the overall profitability of all the three oil marketing companies.
Soumeet, thanks for putting this into perspective. So it won't be a particularly good reported quarter 3 from the oil marketing companies. Do stay braced for that.